You've been for so many years on the market, you read every book available out there, investors, traders, all the best one. Still, you can't make a single cent on the market, and when you make it, the market takes it all back. You might think that the market is rigged, it's against you, it's not made for you. But it's not the case, it's usually the consequence of what we call biases. They are called psychological biases because they come from your own brain. Let me reassure you, you're not the only one in that situation. So the topic of this video today is to explain what the different biases are, because when you understand what they are, it's easier to find a solution. And then I'm going to put them in perspective, giving you some cases to show you that you're not the only one being affected by this. First one, my favorite one, what we call the FOMO. The fear of missing out. I think we've all been affected by this, including myself when I began. You see something go up, you feel like you're missing the opportunity, so you enter late and then it retraces and go back down and you lose all your money. Or you want to short and you're entering too late as well and price goes back up and you exited off your position. FOMO is usually accompanied with what we call the herd mentality. The herd mentality is whenever someone does something, you want to mimic them and think that I have a crystal ball that's going to predict the future where the market is going to go. Nobody has a crystal ball, even Warren Buffett doesn't have a crystal ball. The idea is to have the highest amount of probabilities on your side, but 99% of the retailers don't look at this, they follow the herd. An example that we all know was in 2021 when GameStop was supposed to go to the moon. What we had is different institutions doing what we call short selling. So they were trying to short the stock to potentially hedge positions that they had. On the other side, we had the retails, a group of people that get built that wanted to push the stock up as they saw that little weakness by the institutions. Therefore, they decided to buy in large quantities the stock, pushing the stock all the way up. And as retailers that were not involved in this group, they were seeing the stock go up, go up, go up. So initially we were somewhere around $4, and we can see that we went all the way to 100. So as a normal retailer that does FOMO and has the hunt mentality, what do? Oh, I'm late on the trade. I still want to get in, but price is way too high. I'm buying right here. 100% it's going to continue to go up. Oop, it goes up a little bit. You have that feeling that you've made it. You're actually right on your position. You've done the right thing to invest at this point in time. Boom, it retraces back down and you get liquidated. If you want to know how to not be affected by all those biases, stay until the end of the video because I'm sharing my whole checklist. A similar thing happened recently with the US-Iran war. People are seeing oil jump significantly higher than what it is supposed to be because we have the US-Iran war. The Strait of Hormuz is affected. Obviously, the supply of barrels is going to be disrupted. When we have lower supply, prices increases because having oil is becoming more scarce. Same thing here. You see oil going up. Let's say you see it at $112 a barrel. You invest right there. Everybody tells you it's going to go to $150 a barrel because the Strait of Hormuz is disrupted. Like anything else, anything that's irrational comes back to rationality. Therefore, right after that, in 1 week or 2 weeks, we had a 35% decrease, recovering almost 2/3 of the oil increase. So this shows you again that following the herd and following the comments even that you see in the media is not going to be the solution for you to make money. Like I mentioned, when everything is beyond what is expected to be like, usually we call that the mean, and the higher the standard deviation is from that mean, the more irrational it is. So of course you can use a bunch of indicators to tell you how big the irrationality is. But at the end of the day, if you missed a move, you just got to accept that you didn't get it, it's fine, you're focusing on the next one. Second bias, the recency bias. Something that happened recently is likely going to continue to happen. Great example that we have is gold. Gold took 105% from 2025 to 2026. This is one of the biggest increase in commodities that we've seen. Same here. Everybody tells you, invest in gold, invest in gold, invest in gold. It's super important. People don't understand that gold is a cyclical asset, so it has its cycles. When you are on these type of assets, which are commodities, again, cyclical, they can go high really quickly, but they can go down really quickly as well. And that's usually what the people forget. Oh, quick break. If you like these type of videos, me explaining how to learn about finance and how to counter all the psychological effects and the emotional that you have when you invest and you trade, don't forget to follow that channel, click the bell to receive the notifications. Don't forget to put a comment below or any questions that you have, I'll answer them. And if we invest at a price that is really high, let's say somewhere over there, we might have benefit from the small increase that we have in gold, but we don't benefit from the whole move. Again, how to benefit from the whole move? You need to have the right fundamental bias at the right time. Meaning you need to do your own research and don't follow what you see on the news. Gold, you can put it in the bank and it's safe and everything. Yes, okay. But the thing is that gold doesn't generate any value. Anyway, for recency bias, if we had to use a case study, we can use Cisco in the 2000s. So while we had the internet bubble. It was considered one of the most valuable companies on earth because they make the routers and hardware that power the internet. So retail investors start to notice that internet is becoming a huge thing. Therefore, they're investing in a stock that's already a huge valuation. It was a great company and of course the thesis was correct. The stock dropped significantly from the 2000 all the way to 2002. And then if you invested at the top in the 2000, it would have taken you almost 26 years. So in 2026, basically to get your money back. The idea is usually what we see on the market is what hasn't been priced yet. It's what we call a discounting price mechanism. Right now, the market reflects what we think is going to happen in the future. Problem is, sometimes future disappoints and we end up being surprised and stock goes back down to something that's again more rational. So now confirmation bias. Confirmation bias is when you look at everything that confirms your existing idea on a stock, on a commodities and where it's gonna go. Let's take the example of the S&P 500 before April 2025. So the S&P was going well. I mean, Trump just got elected, still going up. As we know, S&P 500 is exponential. So let's say the S&P was going up and I wanted to invest here. I do my normal investment. Now, Trump's tariffs arrive in April 2025 and everybody tells you, keep your money safe, it's gonna be the next crash. You missed on that whole 22% downside opportunity. And again, stay until the end of the video because I'm explaining how you can benefit from that. You can't miss out on huge opportunities like those. Those are once in 2 years, 3 years, 4 years opportunity and you're missing them. And this is potentially life-changing sometimes. Everybody tells you park your cash, and you're reading articles and you're watching news and you're watching YouTube videos that tell you, yeah, you shouldn't invest, you shouldn't do this, you shouldn't do that. And then you trust them because you haven't done your own analysis because either you don't have the knowledge or you're too lazy to do it. And now my favorite one, the Dunning-Kruger effect. So it's basically when you know a little of something, you think you know everything. So I put that in perspective on a Venn diagram. So let's say this is, as a beginner, this is what you think you know and this is what you actually know. You know very little. So you're not taking much risk, but suddenly, let's say you take a trade or you have an investment, oh, it goes up 10, 15, 20, 30%. Okay, you think you've made it. You think that now you had that little problem that got solved and everything is going to flow correctly. So what you actually know actually stays the same because you're still at the beginning of the knowledge you're trying to get in finance. But the knowledge you think that you have is way bigger. You think you're all the way in that big circle. It's not the case yet. So like anything in life, it's always going to bring you back down to earth. Then once you go back to that humbling level, I'm not saying you shouldn't be confident because you need to be confident to execute trades. You need to have faith in what you're thinking when you have the proper knowledge to do so, obviously. But once you have it, you need to have confidence in what you're doing and you need to be humble enough to understand that you can't always be right. Once you master the art of being confident and humble, trust me, you're going to be a very successful investor or trader. So, what are the solutions to all of the biases that I just mentioned? Honestly, there's not one proper solution for each. There are multiple, and since all the biases are kind of similar to one another, they have similar solutions as well. Solution number one is trying to find cross-asset correlation. How correlated are the assets that you're trying to trade or that you're trying to invest in? If they're very correlated and you're making a mistake, the probability of you making a mistake in a stock that has a similar correlation to that is going to be bigger. So let's say you put $100 on Apple and $100 on Microsoft. Apple goes down 20%. The likelihood of Microsoft going down 20% is very high. I'll give you an example. For example, WTI and Apple. So Apple in blue and WTI in orange. And we can see that they are not correlated at all. Now, second one, really important. It's called the COT, the commitment of traders. This is to tell you where the positioning of institutions are. Are they net long or are they net short? So for example, in that case, we can see that we have the Canadian dollar, the Swiss franc, the British pound. So we can see how big of a quantity those institutions are buying those currencies. So let's say you want to have a position on the Canadian dollar because you feel like oil is going up and it's going to benefit the Canadian dollar, but all the institutions are shorting the Canadian dollar. Then do you want to be exposed in the direction of the upside or in the direction of the downside with the institutions? I'll let you answer that question, but it's pretty obvious. So now that's your checklist, the most important part of this video. You have three parts of that checklist: the quant rules, the structure, and the psychological rules. The quantitative rules are the rules you're gonna have to put in place to minimize the amount of money you're gonna lose. First of all, a stop loss. I think everybody knows what a stop loss is, but it basically limits the amount that you can lose. If you say, I only wanna lose $100, you're gonna size your stop loss to make sure you only use $100. If you put no stop loss, you can use $100 and beyond that. DCA, this one is one of the most important. Dollar cost averaging. It's investing a little bit of money all the time. So you smooth your DCA curve. So let's say I invest in the S&P 500. In the example I gave before, even if you invested before the April tariff of Trump, so before the market crashed, if you did that DCA since the 2000, you would have a small downside, but it will still be a smooth curve. And obviously, when market is undervalued, you want to increase the amount of money you put on the market. And when market is overvalued, you want to decrease the amount you put. But this is for another video. Then we have something called rebalancing. Say you have 3 assets in your portfolio. Each of them are 33% of your portfolio, which make 100% of it. Let's say one asset performed better than the other. Let's say one's at 36% and another one is at 30%. You want to make sure that the extra 3% that you get is going to be rebalanced in the other asset to make sure you still have the 33%. Now the structure, you need to have a journal. Whenever you execute a trade, an investment, when you do anything in finance actually, you want to make sure that you keep track of what you're doing, what works, what doesn't, what's the best solution to that problem. And in that journal, you should also put the different biases that I mentioned before. Because it's not because you're aware of them that they're not going to come back and they're going to disappear like magic. They're going to come back. If you know and you can acknowledge that they are here, it's going to be easier for you to control them. Now, the psychological part. This is what I call the cool-off period of the activity period. People who don't know Peter Tuchman, he has a cool-off period and he says, after 3 losing trades, I close the computer, I go back home. So for him, his cooling period is if he loses 3 trades, boom, he cools off and then he goes and does something else and he comes back the next day. For me personally, as an athlete, because I was playing tennis at a high level, I like to have that activity period, which can be considered as a cool-off period. Is basically, I go and exercise, I go and play tennis, I go and I do boxing, and I just free my mind of all the stress and pressure that I had on the screens and on the different positions that I took. And I try to really not be on my phone or not looking at anything related to finance during that time. This is why I say activity is one of the most important things, because you free your body and you free your mind of all the stress. I feel like I'm fresh, brand new when I go again on the screen later on during the day or the next day. Devil's advocate protocol. Whenever you enter a position or trade, I want you to find 2 to 3 things that could go against you. So let's say I want to invest in Apple. I have all the convictions in the world to invest in Apple. But what are 3 things that could make my investment or my idea go wrong? And then lastly, like I mentioned before, limit screen and portfolio checking. Whenever you invest in something, you can put alerts, Of course, don't put alerts at every tick of the price because your phone is going to ring all the time, but put them wisely, at different price levels so that whenever something rings, you only check that thing. You don't need to check anything else. I know so many people, whenever they invest into something, they look at it every hour. Every hour, yeah, might increase 0.5%, might decrease 5%, who knows? And who cares? Honestly, put the trade, put the investment out there and then forget about it and go and do something else. And then the last one is what we call meditation. So it might sound a bit fancy, but meditation and visualization are actually super important in finance and nobody really talks about it. But when you meditate and you visualize good things, you visualize your ability to deal with those moments, to deal with those situations, you're gonna be more pragmatic when you're gonna arrive in those situations, and you're gonna deal with them way more efficiently than if you haven't done it. I hope that you liked that video and that it helped you. I think it was necessary to do it because I had many people on Instagram asking me about the psychological sides of things, because the quote that I say and the way I describe what I do is I try to train and think like a finance professional. So the whole thinking part is the knowledge that you're gaining, and the whole training part is what do you put in place in order to mimic, be as close to what a professional would do. And I know many professionals that I talk to from Wall Street or from other big financial institutions in the world that put in place the different things that I just talked to you about, and they obviously know those biases, they all know they're gonna come, but they are able to deal with it because it's their job. Trust me, they've been through the same phase as you of dealing with stuff, and it's been difficult for them as well, but they were able to overcome it because they have a checklist, because they have a plan, they don't deviate from it. Don't forget to subscribe and leave a like and a comment also as well. Ask me any questions. And if you want to follow my different social media, they're going to be in the description below, but I can put them on the screen as well. And if you want to know why I'm not investing in the S&P 500 anymore, go check out my last video. It's going to pop somewhere around here. That was Sandro, and that was how to think and train like a finance pro.